Hello everyone and welcome back for today's video. Today I have planned to compare the two huge flexi cap funds, the Parag Parikh Flexi Cap Fund and the HDFC Flexi Cap Fund. As we all know, the two are the almost well-known names in the world of Flexi Cap Fund, and today we will compare them. And this is not a promotional video, it is not a recommendation from my side, it is just purely for educational purpose so that I can teach you how to compare any funds, multiple funds, and then pick one which is the right for us. Okay. So there are many websites for comparing and viewing all the information about the mutual fund. There is the Coin by Zerota, this is the Ticker Tape, and this is the ET Money. And I'm not what I can say advertising any of them, but I will be using each of them for some different purposes. Okay. Now let's analyze all the funds uh, according to me. Okay. And let me tell you first of a few important ratios for any fund. Okay. Let me show you here. We have few important ratios for each fund, like the alpha ratio. It is the returns generated higher than the benchmark. For example, all the flexi cap funds average for the 1 year or 3 year return, for the 1 year return, let's say is 5%. And if any fund outperforms its benchmark, outperforms all the category, all the average, then its alpha should be higher. Okay. Alpha should be as high is better. So here we can see almost it is equal 4.7 and 4.68. So yeah, we can say both are very good funds again. They have outperformed their category by a huge margin. And the second ratio is the Sortino number. Okay, what is the Sortino number? It measures the returns per unit of risk. That is, if the fund has taken the risk whenever needed, so how much return they have generated. So we can see that Parag Parikh Flexi Cap is a bit better in this ratio, right? It has generated 1.4 of Sortino number than 1.1 as compared to HDFC Flexi Cap. And what is the Sharpe ratio? The Sharpe ratio is the measure of that it denotes the total performance of the fund divided by its downside capture ratio. What is downside capture ratio? Downside capture ratio means when the market performs well, all the fund performs well. But when the market does not perform well or it just goes down, then what is the effect of that on the fund? Okay, so it is also, yeah, higher the better. All the three ratios I told you, alpha, Sortino number, and Sharpe ratio of all the funds, the higher is the better. So we can say that almost in two of them, Parag Flexi Cap is far more better than HCFC Flexi Cap fund. Okay, but we should not just judge the fund just on the basis of some one or two ratios. Okay, there are many other things that we will see. Okay, so yeah, let's deep dive into it. And which fund? This is the HFC Flexi Cap fund that I have opened here for you. In this coin zero, the we can see 1 year, 2 year. This is the per year CAGR return. Okay, that means 1 year was 0.43 because the market is not good from the last year. It's only 0.43%. From 2 years, annually 8.19%. For 3 years, annually 18%. And as you can see, okay, so we can see that in a long run, around almost we can say 15% is we can consider what is 12 to 15% is we can consider from many good fund that it will deliver the return based on that is. See, two main other ratios. That is expense ratio and that is the exit rate. Expense ratio is every time we are purchasing on the amount it is on it. For example, we invest 1,000 rupees per monthly SIP or 5,000, whatever you want. But I'm taking the example of 1,000 rupees. If we invest 1,000 rupees, then it's 0.67% will be cut down and then invested in that fund because the fund has fund managers and many workers and office and then you need money to run, right? So it is for that. The exit load is generally applied when we redeem our funds. Okay. So when we, for example, if we redeem our funds within 1 year, then there is a much higher exit load. And after 1 year, generally it's 0 or 1% more or more. Okay. So we should do, we people generally neglect this expense ratio. But if we are going to continue our SIP or investment in the mutual funds, so to let's say 10, 15 years, which is considered that we should do it, then it makes huge difference, guys. So for example, if there are two funds performing almost equally and one has an expense ratio of let's say zero point 0.9 and one has expense ratio of zero point 0.5, you should definitely go with the fund with zero point 0.5 expense ratio if the performance and everything else is similar. Okay. Now we will see few other important things like here we in coin we will be able to see what are the allocations in which sector and company wise allocation also. So we can see that it is highly invested in all the banks, and then it is going to in the finance sector, in the NBFC sector, for investing for the consumer discretionary and the industries, the industrials, and the healthcare and everything like that. Okay, so we can see here everything. Okay, a few things like that, and let me show you the Parag Parikh Flexi Cap Fund here also, and we should invest in the growth fund, not the IDCW. It is for the dividend basically, and we want the dividends to be invested back so that the compounding works well for us after 10 to 15 years. Why I am saying this period again and again, 10 to 15 years, let me explain you. It is considered that ideally, if you invest in any mutual fund for 1 year, 2 year, or 6 months, then then there is a possibility that it may give us negative return because the markets are volatile, right? So we must invest for at least 7 years. It is statistically proven, so that compounding works well for us. Okay, guys. Now let's move forward. See here, exit load is 2%. For HDFC Flexi Cap, it was 1%. So, for example, we are investing a total of let's say 1 lakh rupees. So, for 1 lakh rupees, the 1% is very small, right? It's 1,000 rupees, and 2% is 2,000 rupees. But as you all know, after 10, 15, 20 years, if we have invested, for example, 50 lakh rupees, then the 1 or 2% will make a big change. So we should invest it, keeping that in mind. Okay, the expense ratio is also 0.1% higher, but its performance is also, as we can see, that it is it will be good accordingly in the recent years. Okay, but 5 year returns of both are almost same, and it is charging very high on exit load and expense ratio. So you should consider that. The people only talk about the flashy 1 or 2 year recent returns and the recent performance, the new fund managers and everything like that. But we should see the future of 15 years, right? Here are also almost same sectors. Of the top two sectors are same financial sectors, and here we can see all the holdings. Okay, and let me tell you guys, both also have different investing styles. Parag Flexi Cap is a value-based investing, and it is a very stable fund. Why I am telling you it is a stable fund? Here is the important research, that is standard deviation. What standard deviation means? How the fund low and high returns is the difference. It is the standard deviation. Okay, standard deviation means how the fund is fluctuating with the market. So it is very fluctuating, except Flexi Cap, and Parag Cap is stable fund. Okay, here are the returns of the 1, 3, 5 year, 3 months, and 6 months. As you can see, the HDFC fund is highly volatile, like from minus 7.48% to highest is 17.88 in the 3 year, while minus 2% to 16%. That is a less deviation here. And the fund size of both are very huge funds. Okay, so I mean it's not like they will just shut down tomorrow. It is this state Flexi fund is running from 31 years 5 months. That is, it is a very trustable fund. From such high amount of years to give this consistent returns is very difficult. And while Parag Flexi is also old, 13 years, we can consider any fund which is from last 5, 6 years. It must be older if we are investing in it. Okay, its category is Flexi Cap, as you all know, and these are the few of the sectors that they're investing. They are also showing, yeah, another factor. It's Parag Parikh Flexi Cap Fund invests also it has exposure of US stocks in its portfolio. Okay, so this is a major. Yeah, so Parag Parikh Flexi Cap has the exposure of foreign stocks also. So it just gives us the advantage of it if we want to also invest some of the money in foreign stock markets, but we don't want to do research about it, we can simply invest in it. While HDFC Flexi Cap Fund purely focuses mainly on the domestic stocks and equity percentage. HDFC has 93% invested in equity currently, and while Parag Flexi Cap has only around 80.4%. Equity has a very high volatility. That's why the standard deviation of this fund is high. But this fund, HDFC Flexi has also given us few good returns with low exit load, low expense ratio. While Parag Flexi Cap Fund has less in equity, so less is the standard deviation, but almost similar is the returns of the 5 years as we seen in the coin, okay, zero, right? And in that, this fund has very less percentage because 93% almost is almost invested in the equity and 0.5, and other is the cash. There is some fixed amount of cash that they need to keep. Okay, while Varakana Flexi Cap Fund have kept equal 11% for the stability in the debt, 81% in equity, and rest maybe in the cash. Okay, so both has a huge amount of cash also. This is the expense ratio according to this platform. But while for buying the fund, we should go to the our broker's website or application and see the expense ratio and exit load there. Exit load is say similar in zero time. It is eating money both. They are showing 1% for HDFC Flexicap and 2% for Parag Parikh Flexicap, right? No lock-in period. That is, we can exit the fund whenever we want. But ideally, as I told you, minimum 7 years is the period for which we should monthly invest for the SIP, and for the lump sum we can take it out whenever we want with a good amount of profit. But ideally, long term is the time for which we should invest. Okay, yeah, good for medium and long term, good for medium term, and these are the fund managers. And yeah, few more things for which we should keep in that in mind. That what is the investing style of the fund that we are investing in. Okay, for example, Parag Parikh Flexi Cap uses the value based investing style. There are majorly three investing styles: value based, momentum based, and growth based. Value based investing style means the if the good companies are available at a reasonable or a lower valuation, this fund buys it and waits for the long term, so that if the company is good, we will get profit. Okay, that is the mindset of the Parag Parikh Flexi Cap Fund. That is, it uses the value-based investing style. While for the HDFC, if we see HDFC Flexi Cap Fund uses the growth-based investing style. That means that the business that are growing, even if they are available at a higher rate or a medium rate, they buy it because they are growing, so they will give profit. That is the thinking of the HDFC Flexi Cap Fund managers. There is a third style also, that is momentum-based, and each style has disadvantages and advantages. It depends on when we are investing. For example, we are investing when the market is falling. According to me, the value-based investing will give us the maximum profit or the minimum loss. Because even if the markets are falling, the value-based investing, the companies, the good companies are available at a lower valuation will not crash. So thus we will get benefited. But in a bull run, in a market going upside, the growth based and the momentum based is good. So neither is good and neither is bad. Okay, we should invest in almost all the categories so that we get the cream from the ice cream. Good, right? And moreover, the other important thing is we should see the rolling returns, not the absolute returns. Okay. So let me show you the Parag Flexi Club's rolling returns in the last 3 years. Rolling returns means from each endpoint to the point 3 years after it. Not just from 1st January 2023 to 1st January 2026. It is the absolute returns. We should see the rolling returns. The Parag Flexi Cap Fund's rolling returns in the last 3 years is around 18.72%. Okay, it is a very, very good consider. Okay, so now let's see for the HDFC Flexi Cap also the rolling returns. It is 23 to 24 percentage, and it's a huge difference. Okay, as we can see, there is a huge difference in both of this. So yeah, now let's see the 5 year rolling returns for both of them. 5 year rolling returns is 17.76 for each. Okay, so now let's see 18.70. Okay, so as we can see, the Parag Parikh Flexi Cap is a bit better in terms of the rolling returns, but in absolute returns, the HDFC fund is better. Okay, so overall, I can say the Parag Parikh Flexi Cap fund is better for performer in last 3 to 5 years. But the exit load, as we discussed, the alpha, the Sortino ratio, the Sharpe ratio, the expense ratio, the exit load, everything comes into the consideration with the investing style and with the fund managers till how much year they will continue with this fund, everything matters. Okay, so yeah, If you have got any knowledge and if you want me to make the video on, to compare any two other funds of any category, small cap, mid cap, multi cap, large cap, or explain you in single fund also, you can comment it down below, like, share, and subscribe. Thank you.